The truth about 529s is 529s are a tax break for the rich. Poor people don't get a lot of benefit from 529s for a few reasons. One, some states give you a tax deduction, and that's helpful. It's true. It is helpful for, even low income people, but it's not worth as much. If you're in the 10 or 12 or 22% bracket, that deduction isn't worth as much as it is to me at 37%. But, some states give you a credit. So it's fine. That's what happens in our state. It's about the same. And that's helpful. But there's no federal tax deduction on this, right? It's a relatively small deduction. I can put lots and lots of money in there and I get my tax form at the end of the year and it's a few $100 off my state taxes. It's not a huge tax break. The money grows tax protected, right? Just like a 401k, just like a Roth IRA. And when it comes out, as long as it's spent on education, it comes out tax-free. And that's a benefit. But it's not so much of a benefit compared to a taxable account for a low earner. A low earner is in the 0% long-term capital gains bracket. A low earner is in the 0% qualified dividend bracket, right? So they're not getting a lot of benefit out of this 529. But for those of us who are in the higher brackets, this can be very helpful. You're able to save essentially with tax-free money. Your money grows a little bit faster. It comes out tax-free and helps you pay for college for the kids. The other problem is if you're a low earner, you don't have the money to put into a 529. Usually you're barely saving enough for retirement for yourself. And you do need to prioritize your retirement over paying for your kids' college. Worst case scenario, they can choose a cheaper college. They can even borrow something for college. You're not going to be able to borrow for your retirement very effectively. And choosing a cheaper retirement has much more drastic consequences than choosing a cheaper college. So keep that in mind, who these things are for. They really are a tax break for the rich. And I love the model. I'd like to see it more often in other things. But one of the great things about the United States of America is that we have 50 states and a few territories. But with 529s, those states are competing with each other for dollars. And so over the years, that has driven states to provide better and better and better 529s. Lower costs, lower fees, lower expense ratios on the funds, better funds, more index funds. Now there are 5 or 10 or 15 of these that are spectacular investment accounts. And even the bad ones are much more like what the average ones, even they're much more average than they used to be. So there's lots of great 529s out there. Obviously, you want to use the one in your state if you're getting a tax break for it. If you're not, choose one of the really good ones. And the really good ones tend to be Utah, Nevada, Ohio, New York. Those tend to show up on the top 5 lists for 529s. So you can just use your state one. You can use your state one for the amount equal to your, tax break and then put the rest into Utah or Nevada or whatever. Some states even give you the same break, whether you use an out-of-state one or use your own. But you just have to figure that out on a state-by-state basis. You can do 529 rollovers from one 529 to another. Some states recapture any benefit you got by using their state plan, but many of them don't. A lot of people worry about 529s and, well, what if my kid doesn't go to college? What if my kid gets a scholarship? What if, it doesn't cost as much as I think? What if I've now saved gazillions in my 529 and they're not going to need that much for college? I thought they were going to go to medical school, but now they're not, et cetera, et cetera. Well, there's lots of options. One of the best ones is to just change the beneficiary to your grandkid. Right now, all of a sudden, you've got an extra 20 or 30 years of compounding in that tax-free account. And now the money that would have paid for one college education is paying for 3. And so that's a cool thing to do with it. Another option is to spend it on yourself, right? You're the owner of a 529. The kid is not the owner. And so you can go take a cooking class or you can go get a JD after you retire or whatever. You can spend it on your own stuff. Another option that came about as a result of the Secure Act 2.0 is this 529 to Roth IRA rollover. So your kid saves money, doesn't spend as much in college, and you tell them, well, great, you can have that as 529 to Roth IRA rollover money after you leave. And that's going to be a total of $35,000. We're not entirely sure how that's going to work, but the details will be coming out over the next year or so. But basically, instead of them putting $6,500 of their money in, they can put $6,500 from the 529 in as their contribution. I think they still have to have earnings equal to that. But that's another exit plan for a 529 if you happen to get a little bit too much money in there. But these are a great way to save for college for high earners. It essentially allows you to have some, tax-free earnings in there. And the more aggressively you invest it, the more tax-free earnings you get out of it. And so I've taken the perspective with my 529 to invest them very aggressively because I figure, what's the downside? So terrible bear market hits when they're 18, like has happened to my oldest, right? She's 18 now, and she turned 18 and started college in the middle of the 2022 bear market. And so values were down somewhat. No big deal. Number one, she's ahead of where she would have been had we invested it very conservatively because of those great returns in 2020 and 2021. But two, the consequences are not that bad. First of all, she's only taken out a fraction of the money in that 529 this year, right? Most of it's not going to come out until later years. And second, worst case scenario, I could cash flow the expenses she has and save those $529 for a sibling or something like that. And so you have lots of options there. And I think it's a good idea to invest your 529s pretty aggressively. This idea that it's all got to be in cash by the time they're a freshman or sophomore in high school, I think is bunk. I think you can continue to invest the majority of it into long-term assets, into their college years, because some of that money is not even going to be spent until they're a senior or a medical or dental student. That might be 5 or 6 years after they start college. So invest it aggressively. Do use it. You do get some asset protection in some states. That varies by state. Check out the White Coat Investor's Guide to Asset Protection for details on which states protect them, which states don't. But it's worth learning about and worth using.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.